Welcome. Good afternoon. Hope the weather is bearable wherever you happen to be. My name is Allan Teichman. I'm a former Ontario and stage management counselor and also a past council president. I'm very pleased to be with you today for this timely workshop on taxes. It looks like we've got quite a good attendance. So clearly this is a topic of interest to others as well. Before we begin, I'd like to read our land acknowledgement statement as well as Equity's statement of affirmation, which is something that we do before all of our public meetings. I'm speaking to you today from Niagara-on-the-Lake, which is the traditional territory of the Anishinaabe and Haudenosaunee, among many others over time. I invite you all to acknowledge and reflect on the long history of your respective homes and the millennia of Indigenous stewardship that predates us all. Let us be as good and as conscientious keepers of that land as those who came before us. We owe it in honor of them and as a duty to those who come after. Equity embraces an open and inclusive environment and encourages respectful behavior that affirms the dignity of all individuals. We further recognize our shared responsibility for vigilance in creating and maintaining this environment. Equity recognizes a shared history with Indigenous, First Nations, Inuit, and Métis people in Canada. And in honor of those who've gone before us, Equity commits to working toward understanding and actionable practices of reconciliation. And because none of you came to hear me, I'm going to pass this all over to our wonderful expert for this seminar, Sunny Widerman. Sunny's been a tax preparer and an advisor since 2002. She's got a growing clientele of freelancers, business owners, and professionals. Through her firm, Personal Tax Advisors, Sunny specializes in helping clients take control of their tax planning by explaining the tax issues that affect them. Hello, Sunny, and welcome.
Hello, thank you for having me. It is a
Very
pleasure.
welcome.
We too have brilliant sunshine today, and it's super cold. I'm wearing so many layers right now. I can't even tell you. I can barely move my arms. So I'm happy to see such a lovely turnout for this event today, as we are just barely beginning to get into the tax season. I'm going to just share my screen here. I have complete faith that this will work without a hitch. Here we go. There we go. Okay, I think that's working. All right. So, yes, thank you for having me. And today we're going to talk a little bit about taxes and how they relate to um, performers and people who work on the stage and behind the stage with performance. It's a special world of self-employment. It's a special world of working in the arts. And I'm happy to help you navigate through. Just to begin, like, why me? Why am I the person talking to you today? Um, I have been a tax advisor and preparer and counselor for it's over 20 years now. I got into the business by accident. I actually had planned to be a writer, and I took a temporary part-time job as a tax preparer in 2002, and I never left. So here I find myself. Now, from the beginning of my career, I've worked almost exclusively with people who are working in the arts, almost exclusively with people who are self-employed in one way or another. It really is the area where I like to stay. I enjoy helping people who are sort of out on their own, which we all are if we are self-employed or if we have some self-employment income. So I have a lot of experience in this field, and I think that's why they call me in. And the reason that I say yes to these requests, the reason I actually do quite a number of seminars and webinars relating to tax for self-employed people and self-employed people in the arts. Um, and there's a reason that I do so many of them. Um, the the best way to explain that reason is with a little story. So a few years ago, we were contacted. It was not actually tax season. We were being contacted in the fall by an actor. She had been an actor for many years, and she had made very modest money. Her income was quite modest, and she had not been filing tax returns. And I understand that because a lot of people who get into the arts, particularly the performing arts, do not do that because they love spreadsheets. They want to do what they do. They want to create their art. They don't really want to do a lot of paperwork. And so she, like a lot of people in that situation, was not doing a lot of tax filing in those years. And by the time she came to me, it had been about 10 years, and CRA had been asking for returns. And what happens with CRA if you haven't filed in a while is that they'll send you a letter or a notification. They'll say, please file this return. Maybe you're entitled to some credits. You should file a return. And if you don't respond to that letter, they send another one. They send another letter. And so that's what they did with her. They sent her another letter. And then she didn't respond to that one. So they sent another letter, which is what they do. And then when she didn't respond to that one, or one of the many in the sequence, they just, what CRA will do if they just sort of give up on getting an answer from you, is they'll just make something up. They'll just file a tax return for you. It's called an arbitrary assessment. Well, no, it used to be called an arbitrary assessment. They don't like us to call it that anymore. What they want us to call it is a notional assessment, but arbitrary assessment pretty much gets the point across. They will kind of make something up. So they'll make something up. They're guessing at your income. They don't really know, and it comes usually to a tax bill. There's a tax bill relating with that notional assessment, and then they want the money. And so what will happen if you have a notional assessment is you can override that return that they invented for you by filing your own. And if you file your own, pretty much, pretty 9 times out of 10, if not more than 9 times out of 10, the return that you file will reduce that tax bill. And so that's what she was coming to us for. She wanted us to please reduce that tax bill because CRA was, not only did she have this giant bill because it was 10 years, but also they were garnishing her wages. Now, a garnishment, of course, is when CRA takes the money before you get it from the payer. So they contacted everybody they knew. Like, this is the other thing about being garnished. It's uncomfortable, but it's also it can be sort of embarrassing because they contact the people who pay you, and they give them a copy of the court order that says that the payer must now divert a certain percentage of the money that they're supposed to pay you and send it straight to the government as your payment on your tax bill. So your payers or your employers get involved in this whole thing too, and that's what had happened to her. So they were garnishing her wages. Now, we have a chat box and we have a Q&A box. When you have questions, I would ask you to put them in the Q&A so that I can keep an eye on what the questions are and keep track of what I've answered and what I haven't. But in the chat, not the Q&A, in the chat, does anybody want to guess what percentage of her income was being diverted to CRA under that garnishment demand? Does anybody want to guess? 40%. We're starting high. Oh yeah, 40, 100, 30. Okay, 33. Lots. I like how none of you said like 5%, like something tiny. All right. Does anybody else want to get their vote in? Because if you're right without going over, you win like bragging rights, which are totally redeemable for cash and prizes. Okay. All right. So looking at all these guesses, we have guesses ranging all the way from 15% to 100%. And I am going to give it to the very Scottishly named Duff McDonald because the answer was 100%. 100% of her income, as she earned it, was going straight to CRA because she hadn't filed and, of course, hadn't paid that tax bill. So understandably, she really wanted to bring that bill down. So she needed 10 returns filed. She needed a price on that. I put the price together. Now, 10 returns, it can be done. We've done it before. We actually do a lot of people who are quite far behind. But when you've got 10 returns, it's not free to get those returns filed. It's a lot of work. And I gave her as many discounts as I could sort of manage, but the total quote was still not cheap. And so when I sent that to her, I wasn't that shocked when she didn't really respond right away. I didn't really hear from her. That was unfortunate, but we'd done what we could. And then a few weeks later, we did hear from her. She got in touch again And she said, I'm sorry I didn't respond earlier, but I've been evicted. So let's recap here. She's got 10 years of unfiled tax returns. She's got a very big tax bill. She's being garnished so that any money that she makes that is not under the table is being taken from her and sent directly to the government, every single dollar of it. And now she doesn't have a place to live. She was staying with a friend. She wasn't on the street, but this is a very, very bad situation. It is what we in the tax business call a disaster. It's very, very bad. Um, it is fixable. I will tell you that it is fixable. It takes a lot of work and energy to fix it. It can be fixed. As I mentioned earlier, we actually do a lot of work for people who are in this exact situation, which is why there's a QR code here, which I'll give you again later, to our guide of like how you dig yourself out of that. Because we do work with a lot of people in that situation. But here's the thing. I don't want anybody who's listening to my voice right now to get into that situation. It is a lot of work to get out of it. It is actually less work to not get into it. And what I'm hoping to give you in the next hour and a half, 2 hours, is the tools that you will need so that you will never be in this situation, because I don't want you there. And that is why I do these talks, because I don't want you there. Okay? So let's get it underway. Welcome to the wonderful world of self-employment. I chose this graphic really with a lot of things in mind. I chose it for a few reasons. Number one, you will notice that that road is not paved. You are making your own road. When you are self-employed, you're really on your own in a way that people with regular jobs are not, and they can't really understand what it's like. And to be self-employed, if you're getting advice from, your dad, but he had like a steady job for his whole career, and he got a paycheck every 2 weeks or whatever. There's a lot of stuff that he doesn't know and doesn't understand because he never needed to. He's never needed to understand this stuff. So you, as a self-employed person, you get to make a lot of choices. You're the driver. You get to go off-road. You get to go toward the things that interest you. You get to decide what's on the radio. You get to decide whether you're going to pull over and look at the world's largest blueberry. You get to make a lot of choices for yourself. It's a lot of freedom, but it's also a lot of responsibility. Because the thing, if you've ever been on a road trip, the thing about being the driver on a road trip is, although you get to make all the decisions in the end, you do not get to take a nap. You have to be awake and aware for the whole thing. Part of that, inevitably, is understanding the basics of your tax picture. Now, we will cover a lot of stuff here. I don't want anybody taking furious notes. I find that stressful for the person who's taking notes and you miss stuff and things. I do have some resources that you're going to be able to download later about deductions and about the GST. And I just don't want you to worry too much about it. Just absorb it, put your questions in the Q&A if you have them. I think there's a couple of questions in the chat that should be in the Q&A. Please move them over. But there will be some resources that you can download later, so I don't want you to worry too much about the details. Now, again, in the chat, please, which of these are necessary for you to be a business and deduct business expenses? Do you need a business number? Do you need to be registered for the GST? Do you need to be incorporated? All of the above or none of the above? Which of these do you think are necessary in order to basically write off business expenses, which is kind of key here? None, 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 none. All right. That is absolutely correct. You don't need any of these. All you need to do, no, you don't even need a business number, nothing. All you need to do is bill somebody. Once you bill somebody, you're self-employed, at least for that income, that's self-employment income. And you can deduct the business expenses that relate to that income. The general GST, the general CRA philosophy here is that you should pay tax on your net profit, not your gross. So you don't pay tax on what people pay you. You pay tax on what's left after you spend whatever money you have to spend in order to make that money. being in business means that sometimes you have to spend some money to make your money. And CRA wants you to deduct that from your income and only pay tax on the net. So this being the thing, so your net profit is your gross, meaning all the money that people have paid you, minus your business deductions. So obviously, the bigger your business deductions are, the less profit is left over to get taxed. We want, therefore, to be able to write off as many business deductions as we can, as are allowable, or as we, I don't want to say that we'll get away with, but that are allowable to bring our taxable income down as low as we can possibly do it. The heavier your business deductions are, the lighter your tax bill is. And good news for a lot of people who are self-employed, some expenses that you're already incurring, including your car, your home, and your computer, you are already paying for those things, but once you become self-employed, those very same expenses become deductible, which they're not if you're not self-employed. So this is one of the benefits of being self-employed, is the ability to write off expenses. Some expenses you're going to incur because you're self-employed. Others you might have incurred anyway, but now you get to write them off. But the question always is, what makes a valid business expense? What's okay? What's not okay? The problem with this question is that there is no big sort of directory of expenses with a yes or a no beside it, so that you can just, look it up and see if it's deductible or not. There are a couple of things that are absolutely not deductible. For example, a golf club membership is not deductible. Like literally, there's a rule about that one. But if you take the number of rules, they apply to hardly anything. And then everything else is a matter of context. It's a matter of the situation. What you want when you're writing off a business expense is to be able to defend it should CRA ever come to ask you about it. And the way that CRA looks at business expenses is that they apply a principle to the idea of the business expense to determine whether it's valid or not. You have to apply the same principle in order to determine whether CRA is going to like it or not, or at least to prepare your argument in the event that CRA asks. So what is this principle? It is the reasonable expectation of profit. Now, that is a very small phrase, and it's very meaning packed. All those words matter. So let's look at them in smaller pieces here. So profit is what we were talking about before. That's the net profit. So in order for there to be a profit, you have to have more income than outflow. So a business expense typically should earn you more money than it costs. It should profit you. It doesn't make any sense to, buy a $80,000 RV in order to do a Breaking Bad fan film that you're hoping will make you a couple bucks on the internet. Like it's not, the expense has to be less than what you're planning to earn back by incurring that expense. That expense has to be reasonable. And by reasonable, what they mean here, and CRA uses the word reasonable a lot. The word reasonable always means the same thing to them. It means from the perspective of a disinterested, that is not a bored person, but a person who has no dog in this fight, a disinterested but reasonable person. Would a disinterested, reasonable person agree that you have this expectation of profit? And I do want to point out that word expectation too. Sometimes you're going to spend some money to try to make some money, and it's not going to work out. The fact that it doesn't work out does not invalidate the expense. You do not need to make a profit for the expense to be reasonable. You just have to have a reasonable expectation of profit. So you need to be able to show that you have a decent likelihood of a decent amount of income that is made possible or is made more likely or is made larger because of this expenditure. That's the reasonable expectation of profit. So let's see if there's a couple of questions I can answer here, and then we're going to go to a quiz question. Fun. So asking about our cautionary tale here, how long does it typically take to get into this situation? It depends. It doesn't always take a full 10 years to get into the situation where CRA does notional assessments. The notional assessment always comes after at least one letter asking for the return or demand letter. So one letter is the first letter is sort of a suggestion that you file. They'll sort of say, you should really file because you might have some credits. The next one will say a demand to file, or the word demand will be in there. That's your first demand. Anytime after that first demand, they can decide to go ahead and do a notional assessment. Now, notional assessments are not the end of the world. Like I said, you just file your own return. If you file your own return after a notional, they will absolutely, they're not more likely to audit you. There's no downside to filing your version, especially if your version brings your tax bill down. They absolutely want your version. They don't like their own notional return. They'll put it there and they'll make it official until you file something, but that's not really what they want. So if you haven't received a letter yet demanding filing, you're probably okay. Once you receive the letter, it's time to get on that. Okay, so I'm going to, can you speak to incorporation filing? Is it possible to self-teach this filing? Anything is possible to self-teach. I would say that corporate filing is more complicated than just being a self-employed sole proprietor. And I'm also going to tell you that unless you're making close to $200,000 per year, it's highly unlikely that the money that you're going to save in tax by being incorporated is going to exceed the costs you're going to incur by getting some bookkeeping and accounting help. One or both you should probably get. So be careful with incorporation. I know that sometimes you're sort of forced into incorporation in order to take a grant or in order to get a telefilm. Yeah, that's another grant. But if you are thinking about incorporating for your own reasons, make sure that you have all the facts before you do that. And then it says here that Allan has something to say on that question. Allan, can you, I hope we're not at loggerheads here. No,
I'm good.
you're
I'm
good?
good. I was just checking things off on the list so that the list compact. So you've answered that. Thank you.
Okay. All right. There are questions still in the Q&A. I'm going to keep going and I'm going to circle back. So quiz question. Which of these forms of income trigger the least tax? Is it burglary? Is it sports betting? Is it cryptocurrency trading, hustling pool, or crowdfunding? In the chat, please. What do you think? What triggers the least tax of these things? Sports betting, okay? Anybody want to lay their bet on something else? Because remember, it's the right to brag that you got the answer right in a webinar about income taxes. Hugely, hugely prestigious to get this right. Theft and burglary, burglary, burglary. Crowdsourcing, crowdfunding. Okay. All right. We got a nice, okay. So burglary is, it does trigger tax. So we're talking about the least likely to trigger tax. Burglary does trigger tax. The proceeds of crime, as Chris mentions, the proceeds of crime are in fact taxable. You are supposed to report them on your income tax return. It's not hustling pool. Hustling pool is actually considered to be kind of a job. You control the outcome somewhat because the word hustle is right in there, that you're misleading people so you know what's happening. They don't know what's happening. It's not random whether you won that pool game because you were hustling. So that is actually like a profession of sorts. Cryptocurrency is taxable. It is brutal to calculate. I will speak from the side of your tax preparer. We hate crypto, but it is taxable. Any sale or exchange for one crypto for another is itself a taxable event. Crowdsourced income also is taxable, which leaves only betting on the horses. Sports betting is considered to be sort of a random outcome thing, and much like winning the lottery or a game show in this country anyway, those are considered non-taxable. So regardless of how good you are at sports betting, you never have to report that income or pay tax on it. And believe me, CRA hates that. They've gone to court several times trying to get people to have to pay tax on sports betting, and they have never succeeded to date. Okay, so here's a question. I get a lot of questions about audits. Is this going to cause an audit? Is that going to cause an audit? What is the most common trigger for audits? We're going back to the chat here. Is it claiming a business expense that isn't valid? Is it significant changes in income from year to year, just like up and then down and up and down? Is it business losses from year to year, or is it dumb luck? What is the most likely, what's the most common trigger for an audit? I feel like about 45% of you seem to be getting this one right. It is, in fact, dumb luck. Audits, there are two the second most common cause of sort of getting reviewed is if you have large or frequent business losses. That's the second most common. But the most common thing is you're just in the wrong place at the wrong time. CRA will do these sort of periodic sweeps through a certain industry, for example. And when you file a tax return, you actually include a code indicating sort of what field you're in. And if you happen to be in the field that CRA is auditing this year, then you're kind of highly likely to get caught in it. So there's not anything that you can really do. And I see somebody say moving expenses, and I feel like they're speaking from experience. I will say that there is also a system in CRA where they do a spot check on certain things where you self-report something, but you don't have to submit any proof. And they accept most of those on the honor system, but in some cases they need to do a spot check because otherwise everybody's going to cheat on it. And so if you've been asked to produce receipts for moving expenses, you're not being audited. It's a spot check. They're not actually, unless if your moving expenses were extremely high, they're probably worried that you've made a mathematical error and they want to see your calculation. Otherwise, they've just decided to go after moving expenses this year. For the most part, an audit is like a weather system. There is no thing that you can do to 100% guarantee that you'll never get audited. The chances of getting audited are always low, but never zero. And so when we file returns, we're always trying to file returns that will survive an audit. It's like when the weather is coming, you lash down the patio furniture and you put down tarps and you board up the windows, whatever you do to prepare. But that's kind of all you can do is make sure that your return is as defensible as possible. Now I see some stuff in the chat about, rumors, what you've heard. And I want to point out inordinately high other expenses category. Here's the thing. When you file your tax return, CRA does not see the details of what you wrote off in your business. All CRA sees, if you file electronically, CRA gets your gross and your net and no other detail. They don't see any of it. So if they choose to audit, it's because of something, it's not because of what's on your list of expenses. They may not like what's on your list of expenses once they ask to see it. The first step of the audit is to ask to see that list of expenses, but they have not seen it by the time they choose to audit you. So you get hit by the tornado. We know with tornadoes that in some cases, one person will be completely devastated while somebody very similar to them right there is basically unscathed. What is the difference? Why the difference between destroyed and intact after an audit? Fundamentally, it's your record keeping. If you've got great records, you can defend everything easily with CRA. Basically, it's a small inconvenience. And if your records are a mess and CRA has to sit there digging for a long time, or if your records really contradict what you filed, or if you don't have the records, this is what is going to cause a disastrous outcome from an audit. Good records mean that you can support your deductions. You've chosen expenses for which you have a reasonable expectation of profit. CRA is happy. That's the end of that. So it all comes down to what do you have to keep? And Mostly, you're going to keep proof of your expenses. It's true that you're self-reporting your income as well. CRA usually doesn't ask you to prove that you made money. Why? Because if you say you made money, you're paying them tax. So they like that. But when you say you spent money, you're reducing your tax bill. So that's where they look. They look at the numbers that are going to reduce your tax bill. And so it's your expenses that you have to have proof for. You have to keep those receipts, you have to keep those records and invoices. People will often ask me, can I just keep my credit card statements? Credit card statements are really convenient for being able to sort of see everything on one page. It's very clean, it's very tidy. Everything is there, as opposed to your shoebox of receipts, which might be a little hit and miss. However, a credit card statement is not considered to be adequate proof in the case of an audit. Your supporting documentation for any expense that you want to be able to defend should have the amount that you paid, the date on which you paid it, and yes, the name and address of the vendor that you paid. A good cash register receipt will actually have all of those. You can also keep, an invoice or a receipt that you get via email. Keep those, but the credit card statement alone will not suffice. Now, if you're in a situation where that's all you have, for whatever reason, either for one particular expense or from this moment forward, you're going to vow to keep all your cash register receipts, but at this moment, you don't have them all. Don't worry too much about it. There is a chance. CRA does not automatically disallow anything that's only proved with a credit card receipt or credit card statement. The thing is that they don't have to accept it as proof. It's not sufficient. So then it becomes up to the auditor to decide whether they are satisfied or not. One pro tip, if you can, as much as possible, keep your business and your personal banking and credit card and all that stuff separate. It's not really practical sometimes to keep everything separate, and particularly when you're a sole proprietor, which is a self-employed person who's not incorporated, which is most of us. It may not be totally practical to have two separate bank accounts and two separate credit cards, but if you could, it might be better because it's easier to pick out what's personal and what's business. It makes it easier at tax time, but it's not always worth it. So it's a pro tip, but it's not absolutely necessary to do this. One thing you could do if you do have two credit cards is sort of decide that one is for business expenses and one is for personal expenses. That will let you use those credit card statements at least for your own memory jog, right? You'll be able to see everything that was for business separate from what was for personal. You won't have to do any guessing. So it's good practice, but it's not absolutely necessary. How long do you have to keep them? 7 years. 6 years after the end of the tax year to which they pertain, or 6 years after the year in which you file the return, in case you're filing late. So if you are, when you file your 2025 tax return, which is happening this year, you'll have to keep it for another 6 years from this year. So it's 2026, 7, 8, 9, 10, 2010. 2020. Sorry, 2020, 2020, 2030. I just beg your pardon. I'm kind of lost here. 2030, 2031, whatever. 6 years after you file or 6 years after the end of the tax year to which it pertains. And the reason we have these two dates is because what if you file your return 7 years late, which you can do? You can file up to 10 years after the tax year in question. They're not happy about it, but you could do it. The clock starts when you file. So you're not like if you file a return that's like 8 years old, you don't get to then just like set all your records on fire because they're not allowed to audit you. They are. They can go back that far. Now, typically, when they do review, when they do audit, they'll usually go back either 1 or 3 years, at least to start. If they find that you have the first bunch of things that they ask for, you have it, you present it, it's fast, it's all there. They're less likely to dig any further because you're not looking like a gold mine to them. The messier things are, the messier that first audit goes, or the messier that first 3-year audit goes, the more likely they're going to go back the full 7 years. So the bottom line is good financial hygiene. It's like flossing. which I don't like doing, but I do. Um, it's tedious, uh, but it's actually not a big job. It's just a constant job. So you want to make sure that you're saving your receipts and records. You want to sort them by category so that you can easily find them. And you want to file those tax returns as close to on time as you possibly can. And and label things so you can find stuff. In the end, if the way that you manage your stuff is constant, is consistent, you're more likely to have an easier time of it. So let me take a look at some questions here before we take a little break. Um, I tend Okay. I tend to work from an allowable expense list from past accountants, but some say certain categories are calculated at 50% versus 100%. I would love an updated list or recommendation. The basic rules about what's deductible change very little. I told you that I started doing this in 2002. The only significant change in what you can write off is that bike couriers can write off more meals and entertainment, more meals because they run on food. That is like the only significant change. The other one is that capital assets, which are things that you buy for your business that don't get used up. So your computer, um, your office furniture, those sorts of things that kind of provide value for you for year after year after year. Those are written off gradually in a system called capital cost allowance. The rate at which they go sometimes changes. You put them into a category and then you treat them like that from then on. Other than that, the rates don't really change. Meals and entertainment, 50% is deductible. That is still true, hasn't really changed. So not a lot of changes from that. If you got that allowable expense list from a past accountant, it is probably pretty valid. The only thing I'd say is if they gave you a list of what goes in what capital class, capital asset class, review that one because that could change. That may have changed. Um, Is there a list somewhere in the cyber universe of things you can and cannot deduct? As I said at the very beginning, no, there is not a big list. There are a few things that aren't allowed, like golf club memberships, and everything else is subject to the reasonable expectation of profit, which is very, very context specific. It depends on what you do. It depends on how you do it. It depends on how much money you make doing it. It depends on a lot of things, but there is no definitive list anywhere of what is deductible and what isn't. Um, some expenses are just the cost of doing business, e.g. casting site subscription, gym membership. Okay, two things. Casting site subscription, yes, write it off because it's logically a disinterested person would understand that if you're not in the book that the casting agents look at, you are not going to get cast. So remember that we're talking about a reasonable person's perspective. It is reasonable that if you want to get cast, you have to be in the casting directory. You have to be in the casting workbook. I don't think that would be hard to defend. Gym membership, however, hard to defend. It is one of the few things that is on the no-no list. Gym memberships. Memberships to clubs or facilities where the primary activity is sort of like physical activity or playing a sport, absolutely not allowed. That said, the reason it's not allowed is because people used to write it off as, oh, I need my golf club membership because that's where I do all my schmoozing. And CRA basically thought that was bullshit, that you were basically joining a golf club because you like golf, and the fact that you did your networking there was incidental. Um, for people who are actors and models, and I know that there must be some on this call, I would say that the reason for going to a gym is different, and I would be willing to fight for it. But when it comes to something like that, where the rule says one thing and the spirit of the law is something else, so I would say the spirit of the law is that you can write off a gym membership if your body is part of your, what you're selling. Sorry, it sounds gross. That's the spirit of the law would say it's allowable, but the letter of the law says it's not. I personally will always go for the spirit of the law. For the most part, CRA goes that way too. But when you are in one of those conflicts and you're going to go with the spirit of the law, when the actual law says no gym memberships, but the spirit of the law really says that it should be allowed, I would say be ready to fight and be ready to lose. Gym membership specifically. Okay. How long after you file can you be audited? 6 years from the date that you file, or the 7 years from the beginning of the year to which it pertains. 7 years. Keep everything for 7 years. And if you file late, keep it for another 6 years after you file. That's how far back they can go and audit you. That's why that's the rule. Okay, there's a super long question here. There's a few questions I have not gotten to, and hopefully I will be able to circle back. And somebody's asking about bookkeeping recommendations. A lot of sole proprietors really don't need a bookkeeping software or anything. You can usually sort of get away with just sort of like an Excel sheet or just, a list. But if you want to use bookkeeping, asking whether or not it's connected to CRA, none of that stuff is connected to CRA. That would be a breach of privacy. It's not. As for reasonable price, you're going to have to do your own shopping. I can't really recommend bookkeeping software here. I feel neither qualified nor, mostly I just don't feel qualified to recommend bookkeeping software. I have a piece of tax trivia here. Maybe you've noticed I like to have a few audience participation moments in my webinars. So let's take a look at this young woman here from the 1950s. She lives in Jersey, not New Jersey, the original Jersey. This is Jersey, part of the UK. What does this woman in Jersey need to have in order to discuss her tax affairs with her government? In the chat, anybody know? Husband or father? If you look really closely, you'll see that she does have a wedding band. So she's got a husband. Yep, she's got a husband, but that's not sufficient. What does she need? What does she need? We're living in quite the world here. What she needs, and Doug, you're very close. Yes, she needs his permission. Actually, she needs her husband's written permission to talk to the government about her own taxes. Now, for bonus points, aside, so she needs written permission because she lives in the 50s. When did that law change? For bonus points, when do you think that law changed? It changed, but when? The 70s, the 2000s. Doug, can I tell you that you're a pessimistic person, the 2000s. Yeah, too late. Yes, definitely too late, for sure. Okay. Oh, we're getting specific. 1973, so specific. So Doug, I accuse you of being pessimistic, but that's just to throw you off because, of course, you came the closest. That law changed in 2020. That's when that law changed. So, hooray, feminism is what I would say to that. Okay, so getting into a topic that's a little bit meaty. People always want to know a bit more about the GST or HST, and I'm going to try to describe it in a nutshell. Not that easy, but I'm going to give it a go. So before we talk about the GST, the HST, I'm going to talk about what some pretty key terms mean here. So first of all, the GST is the goods and services tax. It is a sales tax applied at the federal level across the country. It's 5% everywhere in Canada. The GST is the same everywhere. Some provinces have their own sales tax. On top of the federal sales tax, they have a provincial sales tax or a PST. And some provinces, in order to simplify filing and simplify the paperwork and the administration of these sales taxes, combine the two taxes into a single tax that is administered in one way with one form. And that is called the harmonized sales tax. So the harmonized sales tax is for the provinces that have opted into it. They charge both, they're still charging both a federal sales tax and a provincial sales tax, but they're treated as one amount, and there's only one there's only one return to file. There's only one deadline per return, because in provinces where they have these two things separate, which some provinces, for example, British Columbia has these as separate things, there are a set of rules of qualification for the PST that's different from the GST. There are rules about when to file for the PST that's different from the GST. There are rules about what you report and discounts and remittances, very different from the provincial sales tax versus the GST. Whereas somewhere like Ontario, we have one tax, we have one set of rules, there is one form. So provinces that decided to harmonize their sales taxes are called participating provinces, and they have one sales tax, and then other provinces will have either a combination of GST and their own provincial sales tax, or in the case of something like, say, Alberta, Alberta doesn't have a provincial sales tax, so they only have the federal level GST. So those are the terms we're talking about. Now, how it works in a nutshell. So I'm going to try to explain the entire GST system on a single slide, like bullet points. And if you look at the slide, you'll see there's not even a lot of empty space left on it. And I'm still going to try to do it on this one slide. All right. Pray for me. Here we go. So to begin with, you're going to remit any GST or HST that you collect. That's you don't pay this tax as the business owner. If you're registered for the GST, HST, you are not paying this tax to the government when you file your GST return. You are instead collecting it from your customers and taking what they gave you in tax and giving it to the government. Next, you get to take back any GST or HST that you spend on your business. So when you spend GST or HST on a business expense, that GST or HST is refundable to you. So one of the benefits of being registered for the GST, HST. You're going to report the amount that you collected, and you're going to report the amount that you're claiming back on a return. You have to send that return in regularly. So when you first register for the GST, HST, you will register to file either quarterly or annually, most people. Whichever you've opted for, that's how frequently you must remit a return. Even if you didn't have any business, even if you didn't do anything, the return has to be remitted that frequently. Whatever frequency you set up, that's how frequently you have to file a return. And that's it. So it is mathematically impossible to owe the government, more than you collected in GST, HST. Like in terms of the GST, HST filing, you are paying them what you collected from your clients or your customers, and you are claiming back anything you spent. So you're actually, to be registered for the GST, HST is always to be slightly further ahead financially. There's a little more money left in your pocket if you're registered than if you're not registered. It may not feel that way because you're, sending more payments to the government, but actually, in the end, being registered, it is impossible to not do as well or better because you're registered than if you weren't. But let me show this to you another way. So let's say you're not registered for the GST, HST, whatever. So you do a job and you bill the client. In order to do that job, you've incurred some business expenses. They go away. And what's left is your profit. This is what you're going to pay income tax on. Compare this to if you're registered for the GST. So if you're registered for the GST, let's say you're billing the exact same amount. So you're charging them the same amount, but because you're registered for the GST, HST, you must charge them a tax on top. Now, in either case, you are incurring those business expenses in order to do that job. However, some of that expense is actually GST or HST that you spent to pay for that stuff. All that goes away. And then when you file your return, you give the government what you collected and you take back what you spent. And so your revised profit, you can see, is a little bit, everything below that dotted line there is a little extra profit that you got to keep for yourself because you're registered. So that's what I mean by you can't really do worse as a registrant than, even if you have no business expenses, all you're going to remit to the government is the amount that you already collected from the customer or the payer. When do you have to register? When you cross that $30,000 threshold. This is $30,000 in any 4 consecutive calendar quarters, essentially a year, but that year doesn't have to be January to December. It could happen between April and March, whatever. In this 12-month period, if you bill more than $30,000 from self-employment, you've crossed the threshold and you've become big enough that you're supposed to become a GST/HST registrant. So what counts there? Only self-employment, but all your self-employment. Any income that comes from self-employment, that is part of the 30,000. However, if you also have income from a salaried job, and if some of your income comes from grants, neither of those is included in the $30,000 threshold. And since I know that there are a number of people here who are quite musical, music lessons are also not taxable. They're also exempt. So if a portion of your income comes from giving music lessons, those also are not included in this $30,000 threshold. So you need to charge and collect it. If you become registered, you must charge and collect it. You have to file regular returns, and you must remit certain amounts back to the government. Those are your obligations from the moment that you register for the GST/HST. I understand that this charging it isn't fun, filing returns isn't fun, remitting money isn't fun, and so a lot of times people don't really want to register, and I get it. However, I do want to warn you of one thing. I told you before that I'm always getting asked, will such and such activity, will this deduction raise a red flag? Will this get me audited? Will this get me in trouble? I'm asked about that, about business deductions all the time. And like I told you, they don't even really know what you deducted until they audit you. So there's usually no peril in the thing that people are asking me about. Where there is actual peril, where I have seen this happen many, many times, is if you cross that $30,000 threshold and you don't register when you're supposed to. Now, if, let's say you build your $30,001st dollar over the last 12 months, let's say you build it yesterday, right? Sometime in the next couple of months, you're supposed to register for the GST. Let's say you don't do it. What will happen? Nothing. Nothing right now. Nothing will happen. What will happen though, because you are filing tax returns, income tax returns that show your gross income. In other words, they show whether you went over 30,000 or not. If CRA notices that a couple of years down the line, they will back register you. If they notice that you went over 30 and you didn't register at the time, they will go back and retroactively register you. Now, remember, your obligations as a registrant are collect, file, and remit. This means that if they back register you and they say, you know what, we're going to say that you should have been registered as of January 1st, 2024. They're going to want returns, and they're going to want the GST or HST that you were supposed to collect back in 2024. And they want it now. Now, you didn't collect it, you don't have it. That's not their problem. That's your problem. So it's really important when you cross that line, even if you don't want to register anyway. Now, if there's somebody hearing me now who did cross that line and didn't register and is now losing it, don't lose it. You're okay. Here's the deal. In practical terms, the only thing that matters is that you register before they notice that you should have. So if they haven't noticed yet, in other words, if they haven't sent you a notification like saying you're over 30, we're back registering you. If they haven't brought it up yet, you're still okay. Just register. You can do it online. There's something called business registration online that'll let you open up a GST account like instantaneously. Do it now. As long as you are registered by the time they look, you will be fine. Even if you're late registering, so you should have registered maybe 6 months ago or 8 months ago, you didn't, instead you're going to register now because I put the fear of God into you. That's okay. As long as it's before they notice, you will be okay. Now that said, like I said, I get why people don't really want to register. I'm telling you that if you have actually crossed that $30,000 threshold where you are obliged to register, I'm telling you, please register. There is, however, a situation where even if you have not crossed the $30,000 line, you might want to register. The thing is that most Canadian business people do know about the $30,000 limit. And one of the things about being a GST HST registrant is when you bill it, you actually have to put your GST number on the invoice. You have to show it. That means that anybody getting your invoice can see whether you're registered or not. And since most business owners in Canada know that you have to register if you're making $30,000, not having a GST number essentially is telling the person who's paying you that you don't make $30,000. Maybe that's fine. Maybe it doesn't matter to you. But if it does, if you feel like you don't want that to be anybody's business, register. Because registering will obscure whether you make $30,000 or more than $30,000. Nobody really knows if you're registered. They only know if you're not registered. So this is a little note there. Okay, let's look at some questions in the Q&A. It's just getting quite long. Thank you, by the way, for all the questions. I really do. I like the questions because they help me know what you guys are interested in and what you are unsure about. I'm sorry that I can already tell that I will not get to all of them, but I'm going to try. Okay. When you get a chance, can you please touch on the issue of most of us gig workers, self-employed, who are now having to pay back CERB? What are our options and how do we fight this? So we have fought this in situations where CRA is wrong. So the first thing I want to point out is that CRA is going back to assess your eligibility, and it's by biweekly period. If you remember, this was a biweekly or was it a monthly payment? Whatever. For each payment covers a period. Your eligibility is judged per period. So you need to go back and look at the requirements. Off the top of my head, I don't remember anymore how much you had to, like once you got over a certain amount, you're not entitled to CERB anymore. It was probably about $2,000. You need to break down your income and expenses into those periods and show which ones you fell below the threshold so that you are still allowed to have CERB. And then you send that all to them with a cover letter saying, I think you're wrong. I don't think I owe this. Here is my breakdown. I'm ready to provide proof. And then you have to wait. So we put in a comprehensive response to CRA saying that one of our clients owed a bunch of CERB back. We broke it down period by period, and we proved that for most of those periods, he was in fact eligible for CERB. And they agreed, and they reduced their ask by $11,000, which is a big deal. However, it took them 10 months to respond to our package. So be prepared to wait. In the meantime, you're still going to owe the money. Interest is still going to accrue on that. However, if you fight and if you win, they will not only back out what they say you owe, or at least a part of it, but they'll also back out any interest relating to what you owe. My point being, if you think you've got a decent shot at winning, maybe don't give them the money up front. Just wait. And even though it's accruing interest, all that interest that relates to amounts that they later forgive will disappear as well. So that's not, it's not a definitive answer, but that's how you do it. You break it down period by period, and you prove that you were eligible for each of those periods. Now, you may find this to be a daunting task. You may not want to do it. You can hire us. We can do it for you. It's not free. I warn you now, or you can do it yourself. If you've got the time, you do it yourself. You may say, wow, that is 10 hours I won't get back, right? But if you're like our client and you get $11,000 for that 10 hours work, you might say that is the easiest, that is the best I've ever been paid for 10 hours. It did take us 10 hours to put his package together. So there you go. If an expense involved a tip, is the tip part of the expense? We treat it as part of the expense. We've never really been challenged on this. But I can't tell you for sure whether CRA would have a hard time with it. I think that if you're going to give a tip, it has to be a reasonable tip, like between 10 and 20%. Because I think that if you tip like 50%, they're going to say, well, that's not reasonable. So if you're going to try to write off the tip, I would say that to make it defensible, make sure it's within the usual bounds of a tip. What about claiming a portion of your rent and utilities, since we are now doing additions from home, especially if we have a room dedicated to that? But you know what? This is one of my favorite kinds of questions, and I'll tell you why. We're talking here about what's called business use of home. Oh, well, actually, it is my favorite kind of question, and the reason why is that I have a slide for it. However, as it turns out, I can't find the slide. So the way that business use of home works is that you take the full cost of your overhead. So that's your rent, any utilities that you're paying, or if you own your home, you're going to talk about property tax and mortgage interest as your overhead costs and utilities. And then you take a percentage of that and write it off as the cost of running your office. What's the percentage? The percentage is based on floor space. So you look at the area that your dedicated workspace. You have to treat this as a place where you always work that does not revert to personal use after. If it does revert, the calculation is a little bit different. So assuming that you have a spot where you work, where you keep all your references and you keep your computer and your desk, and this is where you work from in your little area where you do your auditions. If that is a dedicated space, you figure out how much square footage that space takes up, divided by the total square footage of your apartment or your home. And that percentage is what you multiply your rent by to get the amount that you can write off. So say you're living in a one-bedroom apartment and you're paying $2,000 a month, and you find that your workspace takes up about 10% of the apartment, then you're going to get to write off $200 a month as your business use of home. So that's basically how it works by floor space. Now, if you're working in a space, for example, like when you work at the kitchen table, but then when it's dinner time, you actually eat at the kitchen table, then you actually have to take that percentage and you have to divide it in half, because sometimes it's not business use. So you're limiting it by the floor space that your business takes up, and also limiting it by how much of the day it is business versus personal use. Okay, that was that one. Okay. So I'm gonna keep moving.
So, Sunny, there are a number of
Yes.
GST, HST questions toward the
Okay.
bottom of the list, and I
All
wonder if
right,
you
let me
might.
scroll down then. Quick thing, what are categories for filing? If you download my deductions guide, which is what this particular link is for, the categories are there. Also, if you look at Form T2125 from CRA, those are the categories as well. I will say that most categories, they're all calculated more or less the same, except for meals and entertainment and capital assets. Everything else is pretty much calculated the same. You don't really have to worry too much about getting categories perfectly correct. All right, let me go down and look at some GST questions. What happens if you collect HST for Ontario, but also you have a few jobs that are in Quebec? So the way that GST works is, oh, sorry, is that flipping through? I didn't mean that to do that. Sorry, hold on. You charge the GST that is relevant for the province that you're doing the work in. So if you are working in Quebec, even if you're typically in Ontario, if you're working in Quebec, you are going to charge what they charge, which is GST. They have a separate PST system, so you're probably going to just charge the 5% GST there. So it's either where you did the job, or if you do something remotely, so you're in one province and the payer is in a different province, you charge according to the GST HST rules in the payer's province. That's where the job is considered to have been done if you are physically in one place and they are located in another place. But if you're physically doing the job in another province, you charge the GST or HST according to their GST HST rules. Is the GST is the small supplier threshold the $30,000 net or gross? It's gross. So if you're doing enough business to cross that threshold, if you're being paid 30,000, even if your profit is 1,000, you have to register. The fact that $30,000 is flowing through your business means that you're big enough to be registered. Some companies don't pay HST. They should, but they don't. Is there anything that can be done on taxes to mitigate losing dollars? Yes. I don't like the idea that the payer puts you in this position. It's weird for them too. Because remember that I said that if you're registered for the GST, HST, you get to claim back the GST or HST you spent on your business. Which means that if the payer that you're working for is registered for the HST themselves, they're going to get back any GST or HST they pay you. So it becomes doubly ridiculous that they won't pay it to you. But that's me being annoyed. It's not a helpful answer to you. The thing that you're going to do to mitigate this, if they say they just won't pay, which I don't know, you're going to bill it. What are they going to do? Like if let's say you're in Ontario and you bill them $1,000 plus $130 HST, are they literally just going to give you $1,000 and say, pee up a rope? Okay. If that happens, what you're going to do is take the money that you did receive and do some arithmetic to find a fee plus HST that totals $1,000. So basically, it would be like, I think it'd be like 88.75 plus tax would total exactly 1,000. So then you're only going to declare as income the 88.75% of it that is considered to be your fee, and the rest you're going to remit as HST. You are going to take a hit that way, but it's less of a hit. So on $1,000, you would basically, if they're not going to pay you the 130, you're going to treat the $1,000 like $887.50 of income, and then the additional, oh gosh, 11, whatever, 12,000, 120 bucks or whatever, that's going to be considered HST, and you are going to have to remit that. You are eating it, you are losing it, but at least you're not paying tax on money that really you didn't get to keep. It stinks. Another thing about any company that says that they just won't pay it, does anybody have a guess as to who this guy is? Who is he? What is he? I'll give you a little hint. I have a translation of the Italian that's underneath him. There it is. Secret Denunciations. This was actually, it still exists. It's in Venice, outside the Doge's palace. And it was like the mouth was like a little mailbox. And you could basically put a secret note saying that somebody was evading their taxes in there. Obviously, we don't have these anymore. That's a shame, actually. We don't have these bronze boxes, but there are tip lines. So if you have a company, if you know of a company that is not obeying the tax rules, for example, by not paying you the GST, HST that they are obliged to pay you, maybe think about the tip line. That's a little idea. That's fun. Why is income from teaching music tax exempt? I don't know. It just is. That's the law. The list of things that are tax exempt, like GST exempt, it's not tax exempt. You still have to report it on your income taxes. Why is it GST exempt? Just because. I'm sure there was some kind of court case and a battle and blah, 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 but it is exempt. I don't know why. Just being honest. What if you are working in the USA where you can't charge them GST? That is correct. The GST rate for payers who are outside of Canada, the GST rate is 0%. You bill them 0%. So that's it. You don't charge it. You don't charge it. You're not obliged to remit anything. You're not obliged to collect anything from them, and therefore they're not obliged to remit anything. It's just all of it. It's just all zero. If I do a show on a reserve, do I still ask for HST if I have an HST number? If you have Indian status and you're on a reserve, you do not charge HST, GST. That income is not only exempt from the GST, HST, it's also exempt from tax. It's completely outside the tax system. If you are yourself, you have the Indian status card and you're on a reserve. But if you're on a reserve, but you don't have the status, Or if you have the status, but you're not on the reserve, you charge it. Okay, what are we doing here? It's 425. Let's see. What if you're a dual citizen and you earn residuals from one country and not the other? Is that included in the 30,000? Your worldwide income is included in the 30,000 as long as it's self-employed. So it doesn't even matter. Let's say you make all your money. I told you that you don't, that if you have a payer who's outside of Canada, you charge them zero HST, right? Or GST. That does not mean that that income doesn't count toward the 30,000. The 30,000 is a measure of sort of size. And even though that's why it's 0% and not you don't charge it, right? We don't say you don't charge GST. We can say that, but that's not the official wording. The official wording is you charge them 0%. And that is because that income is included in the 30,000. Okay. All right. So there's a bunch more questions about the GST here. I do want to go very quickly through the last segment of my talk. And then if I've got a little more time, I'm going to cover the rest of the questions here. I did have a suspicion that this would happen. We've got a large group. It's a lively group. So there are more questions here that I can tackle in a 2-hour period. I'm doing my best. But let me just cover the rest that I wanted to cover here, and then I'll try to circle back and see how far I can get. All right. So let's talk about setting aside money for tax. One of the things that people who are self-employed don't have to think about is setting aside money for tax. When you have a salaried job, and most of us have had one at some point, if we don't still have one now, you know that you don't get your full pay, right? They withhold tax, CPP, and sometimes EI, right? Those withholdings are legally required. If you are an employee and you're making a certain amount of money, the payer is obliged to set aside tax for you. It is an estimate of tax. It's not what you definitely owe. It's an estimate of what you owe. The government determines how that estimate is calculated. That's dealt with. And you'll know when, if there's ever been a time when you've just been salaried at a single job and had no other income, you know that you often get a refund. And that refund is because sometimes that estimate is too high. So the estimate is that you owe X number of dollars, but when you file your return, it turns out you don't. Maybe you made a big RSP contribution, whatever. You've overpaid your taxes, too much has been withheld, so you get the excess back. So a refund is the result of overpaying your taxes in the year. Because of that, it's very rare for a self-employed person to get a refund because most people who are self-employed are not paying their taxes through the year. Instead, you have to be ready to pay the taxes at the end of the year. How much? Well, you remember that I told you that you don't get taxed on how much you get paid. You get taxed on the profit that's left after your expenses. You don't really know what that profit's going to be, do you? You just don't really know until you finish your calculations, which you're probably doing right before you file your taxes. So what do? Well, for a lot of people, I would say you want to start with one thing that you do know is how much money is coming in. You may not be calculating your expenses from day to day to day, especially if you have like business use of home and car use and all kinds of expenses that are kind of spread out and weird and haven't been separated out yet. But you know what's coming in. You get a check and you've got the money right there. How much do you set aside and just not spend? Minimum, I'd say 15 to 20% to estimate how much tax you're likely to owe after you calculate your net profit and do the whole rigmarole. If you want to be really safe, or if you are a person who keeps their business expenses extremely low, go closer to 25%. So writers tend to have low expenses. That's why I call this sort of the writer's percentage. But some people, even though they do a job that other people spend a lot of money on, some people just don't spend a lot of money on their business. And if you don't, then go closer to 25%. The more money you set aside for tax, the less likely you are to have an unpleasant surprise when you finally do your tax return. And the other thing is that you want to, of course, set aside any GST or HST you collected too. So you're going to set aside any GST or HST you collect, plus 20 to 25% of your gross. And that should be enough to cover your taxes. It may be a little too much, which is great because then you pay what you owe and you take the rest and you, well, drink it. Or even if it's not enough, it's usually pretty close. 25 is a very safe number. That plus the GST you're collecting. All that said, when dealing with CRA, there is one important thing to be aware of. And now I want you to just, I hope nobody here has like a heart condition because I don't want to shock anybody so that they pass out in front of their computer screen. But here's the secret. They are bureaucrats. That's the secret. CRA is run by bureaucrats. This is not a knock on CRA. A bureaucrat, by definition, is somebody who must obey a set of very strict rules in what they do. Having our tax system run by bureaucrats means that everybody is being held to the same set of rules. You don't get treated differently because the agent likes you. And also, the agents are not working on commission. That's important to know. And all of this, the fact that the agents are following rules and that they don't work on commission, it matters because if they're not working on commission and they're following rules, the end result is that they have a great love for paper. They line their nests with it. Having it makes them happy. Having it makes them warm. Missing a piece of paper makes them break out in hives. It makes them sad. And for that reason, deadlines are everything to them. The date on which they're supposed to receive a piece of paper matters to them a lot more than you would think. As a human being, you think it's all about money because that makes sense. But the reality is, for the bureaucrat, it is much more often about paper. And making them wait for paper, being late with paper, because you've taken a piece of paper that they're expecting to see for their nest and they don't have it now, makes them very, very uncomfortable. There are two consequences to making CRA wait. You can make them wait for paper. You can make them wait for money. If you make them wait for paper, they bill you, basically they fine you. That's a penalty. If you make them wait for money, they charge you interest, as does everybody that you make wait for money. But here's the weird thing. CRA penalties are almost always much, much larger than CRA interest. Now, why am I making a big deal about this? Because the point here is that a lot of times when people, especially if you're self-employed and you're new to it, you put together your tax return and you discover that you owe tax and you don't have the money because you didn't realize you were going to owe it or because something came up and you spent it, whatever. And there is a strong temptation to just hold off on filing the return until you have the money to pay them. Don't do this. File on time, even if you can't pay on time, because making them wait for paper is more expensive than making them wait for money. File the return and then don't pay. Let them charge you the interest. You'll pay it when you can pay it. If they call you, you're going to talk to them, tell them what's going on. They'll usually try to make some kind of arrangement with you, but do not file the paper late. It doesn't make sense that the paper is what's important until you remember that they are bureaucrats. And to them, making them wait for the paper is very, very stressful. So don't. File on time, even if you can't pay on time. Brings me to an interesting side note here. The most common reason, if somebody comes to me and says, they froze my bank account, CRA froze my bank account, the number one reason for a frozen bank account is not that you owe money. The number one reason is because you haven't filed GST returns. That's the most common reason. And by most common, I mean every single time a client has told me that their bank account has been frozen, it has turned out to be because they didn't file their tax returns, their GST returns specifically, because the GST people are assholes. Now, they may say to me, but Sunny, I didn't make any money that year. I didn't do anything that year. I got nothing to report. You have to report that you've got nothing to report. You have to file a nil return to say, I didn't do anything. They're happy with that. It's not the money. It's the return. It's the paper. They want it. So deadlines matter a lot. Obviously, tax time, we're just entering into it. Tax filing deadline, April 30th. Or is it? Um, Surprisingly, large number of people don't know this. If you have self-employment income, as even if it's only part of your income, if any of your income comes from self-employment, you have a deadline extension on your income tax filing. You have until June 15th to file your tax return. If any of your income comes from self-employment, even if you have a regular job as well, if any of your income comes from self-employment, you have until June 15th to file. Not only that, but your spouse or common law partner also has until June 15th to file. Just because one of the numbers from your return shows up on their return, so if you don't have that number until June 15 at 11 p.m., they don't have that number, so they can't file. So you and your partner, if either one of you has any self-employment income that you're reporting on an income tax return, you both get an extra 6 weeks to file your return. Now, I've heard that CRA has quotas. Is that true? I don't know. I'm not in CRA, so I don't know. Right now, I would say in terms of CRA having quotas, CRA is extremely overworked right now. That's why it took 10 months to get a response to our letter. They are very understaffed. They are very overworked. They are definitely not looking for stuff to do, but they are doing what they typically do. So there are spot checks happening, there are reviews happening, there are letters going out, there's interest being accrued, all that stuff is happening, but they are not looking to do more because they can't. They can barely keep up with what they're supposed to be doing right now. So, taking a look at some questions. Do you claim HST on international work or just Canadian income? So as I mentioned before, your international income counts toward the $30,000 threshold. However, you do not collect any dollars of GST or HST from non-Canadian payers. If you originally registered for quarterly GST remittance, can you switch to annual? And what are the penalties for late GST remittance? Okay, 2 things to point out here. Remittance is the transfer of money. Filing is the putting in of a return. So filing is paperwork, remittance is money. These are separate things. You can file a return without doing the remittance. The penalty for late filing is usually higher than the interest on not remitting. So if you're saying that you registered for quarterly remittance, you don't register for that. You have to remit quarterly if your annual remittance comes to more than $3,000 for 2 out of 3 consecutive years, they're going to start wanting it quarterly. They just want it more frequently because you're a big remitter. If you are not remitting that much, you do not have to remit quarterly, and so nothing happens. If you are required to remit, pay them money quarterly, and you don't make the remittance in time, they will apply interest. Remember, the movement of money, late movement of money is interest. Late filing of the return is a penalty. So if you register to file quarterly, if you register to give them paperwork quarterly, if you're late, they're going to charge you a failure to file penalty. It's usually $150 or so. That's what happens. Can you switch to annual? Yes, you can switch, but you usually have to sort of finish out the current year. We are currently in the first quarter of 2026. You can usually make retroactive changes up to the beginning of the quarter that you're in. So if you're quarterly and you don't want to be anymore, you can go online or you can call CRA and you can switch to annual as of January 1st, 2026. So you'll still owe that last quarterly filing for the 4th quarter of 2025, but then you don't owe another return until 2027. So you can make the change. You have to formally make the change. You can do it through My Business, which is your online CRA account for your GST account. You can do it there, or you can talk to a CRA agent. They'll usually walk you through it too. Yeah. Okay. I live in Toronto and work out of province often. Are meals that are that far away from my home base deductible at 100% rather than 50%? No. The 50% for meals is really based on the fact that you need the meals for sustenance, whether you make money or not, right? You're not eating because you need to make this extra money. You would be eating whether you needed to make the money or not. So the 50% rule is about the fact that some of food is just part of your personal life, and only part of it is part of your business life, the part that relates to the fact that you're traveling. So one, that is actually something that they do tend to, a lot of people don't really understand about meals. If you are out of town, which is to say out of your home region for at least 12 consecutive hours, you can have a meal while traveling, that is deductible. If you are having a meal with a colleague or a potential client or a client or somebody, you're having a meal, a meeting with somebody else in an attempt to make more money, that is also deductible. If you're in your home region and you've just worked a long day and you stop off to get some food, that is not deductible. You have to either be in a meeting with somebody who could potentially help you make money, or you have to be out of your home region for at least 12 consecutive hours in order for a meal to be deductible. And then all those meals are only 50% deductible. That's the rule. Do I have to calculate all the GST I've spent on all my expenses for my income tax return? Okay. So first of all, I'm going to edit this question to, do I have to calculate all the GST I've spent on all my business expenses for my income tax return? You don't, but you are either going to claim back the GST on your expenses or you're not. If you're not claiming it back, if you've just for whatever reason decided you don't feel like it, if you're not claiming it back, then you don't have to calculate it. You're going to write it all off. Okay. If you are claiming it back, then you cannot also write it off on your income tax return, right? So if you spent $100 on something plus 13% HST, so $113 you spent. If you're claiming back the $13, you can't then go over to your income tax return and say, hey, I spent 113. You spent 100 because you're getting that 13 back. So if you're not claiming back the GST, okay, you can leave it in on your income tax return. If you are claiming back the HST or GST, then you must take it off of your income tax return. It can go one place or the other. It can't go in both places. I will say that in terms of money in your pocket, you are always better off claiming it back. You are better off doing that calculation than leaving it undone. However, it is legal for you to leave that money on the table if you don't feel like doing it. I will say when we do taxes for our clients, we do both those things. We actually pull the HST, GST, we separate those things, and we file those returns separately. We do that for you, so you don't have to because people do hate it. But if you're doing it yourself, you have to choose either deduct it from the income tax return and be able to claim it back, or give up the claim and you don't have to deduct it from your income tax. You don't have to do the calculation on your income tax return. Okay. I recently was audited. No, you weren't audited. You were reviewed for income made in the United States for which I had already paid taxes. CRA requested more information and further proof of the taxes paid, blah, 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 blah. Okay. So, I'm not saying blah, 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 because it's a pointless question. It's like, I have a whole paragraph to answer this. If you do, so we're going to take this exact example because I think it's common, where you're working in the US and you pay tax on the income that you made there, but you're based in Canada. And so you have to report that income on your Canadian return, and CRA is going to tax you on it, but you're going to make what's called a foreign tax credit claim. So you want credit for the tax that you paid to the US under the tax treaty that we have with the US, so that your income tax in Canada is reduced by an amount pretty close to what you paid in tax already on that income to the US. For small amounts of US income, usually you can just sort of say, I paid this tax, and they'll give you the credit. The more you made in the US and the more income tax credit you're asking for, the more likely they're going to do their spot check. They want to see the proof. The proof usually consists of, you must show a document from the IRS showing that not only did you owe this in income tax, but you also paid it. That's called a tax transcript from the IRS. And you get one potentially after you file a US tax return. So if you're making decent US money and you're paying tax on it there, and you want to get the credit for it over here, which you should, you're going to need to show, first of all, CRA will frequently ask for your US tax return. So if you haven't filed a US return, forget it. They're not going to give you that credit. Show them the tax return and then follow up with the tax transcript, which proves not only that this was the return that you filed, this is the amount that you owed, but also that you have paid it. Then you can get the credit. Now, if CRA disallowed a credit and the tax year that we're talking about was within the last 10 years, you can still get that credit by applying with all the supporting document in place. So if they reduced your credit to zero and it's a tax year, we're talking about a tax year that is 2016 or later, you can still get it. You need to file that US return and have a copy of it ready. You need to get that tax transcript. You need to pay your US taxes and get the tax transcript. A W-2, which is equivalent to our T4, it shows the income tax, it shows the amount of income that you earned, and it shows the tax that they withheld. It is not sufficient because the tax they withheld could have been too much. Maybe you filed a return to get a refund. That is not the amount of tax that you paid. That is why a W-2 is not sufficient. So if you worked in the US and you were taxed there and you want the tax credit in Canada, if you made some decent money in the US, you must be prepared. File a US return, pay your US tax bill, if any, get the tax transcript from the IRS. You will need it all to defend your foreign tax credit claim. All right. Okay, so I want to find, so we've got 13 minutes left. Let's try to get some good questions here. Maybe 2 more questions, and then we'll wrap it up. Does applying a loss to a previous year when you paid higher taxes get you flagged in any way or flagged for an audit? No. The loss carryback is completely allowed in Canada. However, I'll say it's rare. If you're not incorporated, it's rare because in order to have a loss that you can carry back, it means like you made a loss across the board. Like if you have a regular job and you make a loss on your self-employment, that negative number, that lost money, is applied against your other income. So let's say you had a job where you made $20,000 and then you lost $1,000 in your business. You're just going to pay tax on $19,000. You're going to pay tax on your salary minus your loss. The only way to have a loss to carry back is if your self-employment is your only income, or if your losses in your self-employment are so huge that they wipe out all your other income and your ending point is that you have no income, negative income, then you can carry that back. I will say that large losses, a pattern of very large losses, make you more likely to get audited, of course. So it's not a guaranteed audit, and the carryback certainly is not what's going to trigger the audit. However, if you have like lots and lots of losses year after year after year, CRA is going to have some questions about whether you are actually in business or whether you're just writing off something that you do for fun. How do you complete the GST HST filing? Is there a tool similar to TurboTax for it? The GST HST filing is actually very simple. For most people, you do it online. For most people, you're going to report how much income how much you billed, how much HST you collected, and how much you spent on your business. That's it. If you have those numbers, that's all you enter. It's a lot less complicated. There are a lot fewer moving parts to a GST return than to an income tax return. It's all in the calculation. So in terms of a filing tool, not really, because If you go to my business and you say you're going to file your tax return, your GST return, and you like fill out the appropriate boxes and leave the rest empty, that's it. It's like 3 boxes you need. Most people fill out 3 boxes, maximum 5, and one of them has a 0 in it. It's not, it doesn't really require software because the only calculation is how much did you collect minus how much are you claiming back. That's the whole calculation. So no, there's no tool like TurboTax because it's not complicated like income tax. Okay, 10 minutes left. Let's see. Is the June deadline also when any remittance is due? No. Your taxes are actually still due on April 30th, but that doesn't mean you absolutely have to pay them on April 30th. What it means is that if you pay anytime after April 30th, so let's say you're self-employed, you file on June 15th and you pay your taxes on June 16th, you are 6 weeks late. 6 weeks of interest is usually kind of negligible. CRA's income tax rate right now is around 7%. 6 weeks is like a month and a half. So you're going to pay maybe 0.5%, 0.75% of interest on that 6 weeks late payment. So for most people, that amount is not material. And I wouldn't rush to pay on April 30th if you haven't calculated and filed your income tax return yet. I would just wait till you know the number. Does the $30,000 apply to jobs you invoice or bill someone for? I.e., if you're hired by a theater and given that paycheck, there's no invoicing involved. Is that still included in the 30,000? Yes. Anything that is considered self-employment. So if you are working for money, as opposed to making money through investments or, inheriting money or whatever, when you're working for money, that is all called earned income. And earned income essentially comes in 2 flavors: salaried income, employment income, versus self-employed income. Salaried income is income for which you receive a T4, not a T4A, but a T4. The T4 has salary and wages, CPP, EI, all these sort of withholdings. There's all these withholdings listed on it. That's what defines that from CRA's perspective, typically that the income is considered employment income, that you got a T4 for it. If you don't have a T4 for it, whether you invoiced or just got paid, typically that is self-employment. So if you got paid for a job that you invoiced them for, that's part of self-employment. Yeah, and if they just give you a paycheck, as long as they're not paying you as an employee, which is to say withholding income tax and treating you as an employee, paying into CPP for you and paying into EI for you, those things make you an employee. Employment income is not part of the 30,000. So it comes down to that. Ooh, 7 minutes. I'm looking for a good question here. Is there such a process where the CRA will ask you for future payments of GST, HST based on previous year's financial patterns? Yes. That was what I was talking about, where they ask for quarterly remittances. So if let's say you start out, everybody starts out sort of, let's say if you're filing once a year, let's say, and you start out that way, and at the end of the year, you do your calculation, you file your return, and you remit X number of dollars. If you're remitting over $3,000, if when all the calculations are done, the amount that you collected minus the amount that you're claiming back came to $3,000 or more, and if that happens twice in a 3-year span, they will start asking for quarterly remittances essentially based on what you owed the year before. So let's say that for 2 out of 3 consecutive years, you have to remit $4,000 to them. They'll say, okay, going forward, we want $1,000 every 3 months. You're going to pay quarterly. If you don't make those quarterly payments, they will charge you interest. So interest on the first $1,000 going back a year. Interest on the second $1,000 going back 3/4 of a year. interest on the third $1,000 going back half a year. Like they'll go back and they'll apply interest to each missed payment. So you do have the option in terms of like if you just want to manage your cash flow differently to just ignore it and pay the interest, but that's what's going to happen. And it is based on previous patterns, but they do have very specific rules about that. Okay, I see a very complicated looking question about RRSP deductions. And I feel like I can't comprehend the question quickly enough to give an answer right now. So maybe set up a time to talk to me and we can discuss it then. You will get, I'll send you all, I plan to send you all an invitation to contact me. I'm hard to get sometimes because I can be very busy, but I do want to talk to you all. So if you have a specific question that you want to ask more in detail, let us know and I will try to help you out if I can. What percentage of wardrobe can you claim is deductible? Some clothes are purchased specifically for auditions and some are for both personal and auditions. This is the last question I'm going to answer, and I'm definitely going to answer it because it's an important one. I said before that you can't really 100% avoid an audit. It's kind of random. It doesn't really have much to do with you if you're going to get hit by one. But I can tell you that there are certain things that if you are chosen for an audit, CRA tends to take aim at. And this is one of them, wardrobe. Now, this is a pain because CRA's problem with wardrobe has to do with an issue that is not relevant to you as a performer. And that is that they want things to be fair between both self-employed people and employed people. And because employed people also buy business clothes to use in their work, and they're not allowed to write it off, CRA says that in general, self-employed people also cannot write off the clothes that they do to do their work, that they wear to do their work. Now, I happen to know that for people who do auditions, a lot of times you are going to buy something solely for the audition. And you would literally have never bought it otherwise. This is one of those situations where I feel that the letter of the law, which says we don't like wardrobe write-offs, is in conflict with the spirit of the law, which is if you incur it in order to make a reasonable expectation of profit, it's a business expense, right? So this is a situation where on one hand, it's clothing. On the other hand, it fits the reasonable expectation of profit. So what do you do with it? CRA's specific rule is that clothing can't be deducted if it could be worn in personal life. That's their wording. Now, the budding lawyers among you may see that that is crappy wording. What the hell does that mean? Could you wear it in your personal life? I kind of feel it depends on the person. So, this is one of those situations, like I said before, when the letter of the law is in conflict with the spirit of the law, I tend to go with the spirit of the law, meaning that I usually will let my clients write off clothes for auditions. I will say that if you buy the clothing for an audition, but then you do wear it in personal life, you should prorate it for the percentage of use that's for auditions versus personal life. If you use it once for auditions and then wear the hell out of it later because you love it, you're basically not going to write off any of it because you basically wore it for personal life mostly. If you bought a ball gown to wear to a gala and then you wear it one time to a, I don't know, a wedding. I don't know what kind of weddings you're going to. Maybe you could do 50-50. I don't know. It's a very personal, individual kind of a question. But this is their rule. So if you want to write off wardrobe, that is the argument that you have to win. That you can't wear it in personal life. It is only for business. And if you can somehow convince the auditor that that is true, you will win. but you have to be prepared, as always, to lose. Be if you make if you claim a deduction that the letter of the law says no, but the spirit of the law says yes, and you're going to just try and go for it anyway, always, always, always be prepared to fight and be prepared to lose. That's the final word on wardrobe from me, anyway. So I think we should wrap it up now. It is 5 o'clock on the button. I am very proud of this. So, what I wanted to make a point of here is what are we talking about? Writing off expenses that have a reasonable expectation of profit, keeping receipts, knowing when you have to register for the GST, and filing returns when they're due. This is kind of it. None of it is fun. None of it is something that you're going to look forward to in most cases. And if you are, really get help, because come on. It's all regular stuff. It is boring. It's not impossibly hard. And you may not want to do it, but in 23 years of doing this job, I can tell you, staying out of trouble is always easier than getting out of trouble. And what I'm hoping is that I've given you enough hints and tips and tricks about the way things work today that you can stay out of trouble or at least know when you're in danger. That's, I guess, the best that I can hope for you all. So thank you all for being here. I'm going to hand it back to Allan.
And thank you, Sunny. I don't know if you've been watching the chat, but there have been a lot of people chiming in and saying how much they appreciated this and how useful it was. And I'm sorry we didn't get to all the Q&A questions. We'll try and pull those together into a list for Sunny. And also, Sunny, you were going to invite people to contact you. Is there a good way to do that?
If you signed up for the guides that I sent out, I've got your email address and I will invite you to have a meeting. So that's probably the best way to do it, because that's how I keep myself organized. So let's go from there.
All right. I'm going to close with a comment from someone. Many thanks for the webinar. This was fantastic. I couldn't agree more. Thank you very much for your time, Sunny, and I hope you have an opportunity to do this again.
I hope so too. I loved it.
Okay.
Thanks, guys. Have a great night,
Bye-bye.
guys. Bye.